What do you mean by wolf market? That's one I haven't heard before.
Well, ultimately, it's a somewhat trendless, range-bound market. It chops around a lot, and I think right now, we have
like an angry wolf. What's the imagery?
Well, to make money, you have to be quick like a wolf, right? You have to trade it. You're not necessarily making a big thematic bet, long or short here. You've got to be fast and quick and decisive.
And why do you think that's happening? And I mean, in terms of being fast and quick and decisive, which, I mean, give us a little more detail about what you're talking about.
Maybe a summer wolf, a little sleepy right now, right after 4th of July week. But, we've had big wolf markets, like, for example, back in 2011, where the S&P just finished where it started, right? Almost to the penny.
Right.
And right now, we have had a pretty major correction off the May highs. The market's found its footing again, as it did in the last two corrections, rough order of magnitude the same. The big difference, of course, is that we have the tapering, as you mentioned. We do have this secular potential massive tidal shift in what's happening with rates. And while this could be good for equities from a flow point of view, and ultimately because it's a reflection that the real economy is starting to improve, the market still has to process this, and I think it's processed a fair amount of this, but over the course of the summer, I do think equity market volatility will range higher, but I also think that there's a lot of structural themes supporting equities throughout the summer. And that adds up to a choppy market.
As I listen to you, Michael, what it really sounds like to me is we're back to earnings. Right. In other words, we're over Greece, we're over Turkey, we're figuring out what's happening in Egypt. I mean, et cetera, et cetera. Now it's back to the U.S., it's back to earnings.
Right, exactly. And we're almost over tapering. The markets have, incorporated a lot of this tapering discussion. There's one point I want to make on earnings. We are just getting into the season here, and typically over the last 3 or 4 years, you've seen the market sort of get halfway through the season to sort of make a judgment about what corporate earnings are reflecting about the real economy. I think this season is going to be very different for one key reason, which is that a lot of stocks may benefit, for example, from the higher rate environment and the higher volatility of rates. Other stocks are going to start showing signs of weakness there, and I think investors are going to be increasingly looking at that into the season. So it's going to be a little bit harder to step back and say, wow, this confirms the economy is good or this confirms the economy is bad.
So you don't think that fundamental economic backdrop, if you will be more important to companies than the rate environment? I mean, outside of financials, one would think that how the economy is doing would be the driving factor.
Well, sure, but I think there's corporate earnings are going to be very important, of course, and they do reflect the economy, but there's a lot of other economic metrics outside of earnings that also reflect that, and we've seen that a lot, in the various jobs data we've had over the last 3 days. We've seen that, throughout a variety of economic metrics. So I think it's one more factor here. I know a lot of people are very focused on now it's all about earnings, and it is. But the point I'm making here is that it's going to be a little bit different, and there's a lot more single stock issues going on here than we've had in the past.
So in other words, you can't just say I like the market, or I like tech, or I don't like utilities, whatever. I mean, you actually have to go back to individual names and stories.
Right, exactly.
So for you as a strategist, where you tend to be big picture, what does that mean as you're talking to the clients of Weeden who are looking for your company?
I think as you get into some of the sectors here, clearly we've had a massive volatility in rates, and that impacts everything from the, what I call the sort of convertible bond-like stocks, right? Stocks that took on this bond-like, quasi-bond-like feature through it, and that really defined 2000.
The high dividend.
The high dividend stocks, right? So that could be utilities, that could be some REITs, that could be some MLPs. I think those you're going to see continued volatility. They're starting to base right now. There could be some very interesting tactical trades on the long side. I think, on the short side, I think there's a lot of companies that, have huge exposure to the construction sector, and those are things that I think are going to get a little bit more under the microscope for weakness. So that could be anything from a Home Depot to a home builder.
Why? Because rising rates will discourage people from buying?
Yes, refinancings are.
But don't you usually get that sort of rush as people know that rates are about to go up?
Well, some of the mortgage data doesn't confirm that yet,
right.
And so I think there's a lot of people that are just confused here, and I think that about, do you go now, do you not? And I think that's it may starting to show up, if not into the actual results of this quarter, into some of the forecasts. So I think those are one of the key watch points for the summer season here.